There are currently over 10,000 ETFs available globally with assets under management around $13 trillion. So in this video, I'm going to show you the easiest way to find the best ones for you in just a few minutes. There's plenty of videos out there suggesting specific ETFs, and I've done my fair share as well, but I want to show you how easy it is to find them yourself using a search engine called justetf.com. I would advise creating an account, which you can do so for free, and the first thing you're going to want to do is to select the location that you're in. So for me, it's going to be United Kingdom, English, private investor, click save. You're then going to want to head over to ETF screen out. Now, your first thing you'll see is that I suggested that there was over 10,000 ETFs available globally, but by just selecting our country, it's brought it down to 2003. Now, in order to bring this down to a reasonable amount, we're going to select a few filters. The first is going to be the asset class. Now, you'll see this on the left-hand side here. Now, equity we'll come back to. For bonds, this is essentially a form of debt where you're going to lend your money out and you're going to get a return in the form of interest. This could be loaning your money to governments, it could be to corporate companies. Precious metals will be things like gold or silver. Commodities would be things like oil or gas. Cryptocurrencies you'll see is blanked out, and that's because I've selected United Kingdom, and there aren't actually any cryptocurrency ETFs available for UK investors right now. Real estate, so this would be if you wanted to get exposure to the market without having to buy physical property. And then money markets are short-term instruments that act a little bit like cash. For this example, I'm going to use the scenario that we want to invest into the global market via a global ETF. This is one of the most popular products out there, and it's also going to give us opportunity to explore a lot of the filters. To do this, we're going to select equity as our asset class. Now, if you wanted to, if you didn't want to go down the global route, you could select a specific region. You get even more specific and select a specific country, but you could also get even more specific than that, selecting a specific sector, a specific equity strategy, or even a specific theme. For this one, because we want the most broadest approach, I want the most hands-off, the most passive approach, and I just want to get exposure to the global market, I'm going to select no for all of these. So the first thing is region, we're going to go world, and then in all of the others, we're going to go no sectors, we're going to go no equity strategy, and we're going to go no theme. So already from that 2000, we've brought it down to just 46 results, but we can get that even lower. And to do that, we just need to scroll down and you'll see a few different options. The first one I want you to look at is use of profit, and you'll see accumulating or distributing. This is how dividends are treated in the fund. So a lot of the companies that you invest into will pay a dividend. Now you can choose to have that dividend paid out, or you can have it reinvested back into the fund to grow that fund quicker. For this example, because I want the most growth in the fund, I want all those dividends reinvested back into the fund. So I'm going to select accumulating, which brings us to 25. Next, you got fund size, and you'll see two options here, larger than 100 million and larger than 500 million. Now, this is not a massive deal breaker, but by selecting a slightly larger fund, you're going to know it's got the reputation there. You know it's a large enough size, especially with a global ETF. There's thousands of companies in these indexes, and if the fund isn't big enough, you could run into some liquidity issues. So generally, I like to select funds that are larger than 100 million, which just brings us down to 22. The next filter is replication method. Now, for slightly smaller ETFs, say a few hundred companies, it's likely that the ETF will want to do a full replication. This means if there's, say, 200 companies in an index, the ETF will invest in all of those 200 companies because it wants to track it as closely as possible. The problem when the index is bigger, like it is for global indexes where there's a few thousand companies, it doesn't make sense from a cost perspective for the ETF to track all of those companies. And actually, the performance of the index is driven by a much smaller percentage. So what a lot of ETFs do is to do a sampling approach where they'll look at correlations across the fund and they'll do a percentage of the fund where they can get the exposure without all the cost of investing into all of the companies. There is another option as well, which you see swap-based, and this is a form of financial derivative where they're trying to replicate the index synthetically. There are slightly different characteristics here and slightly different tax implications, but we won't get into that today. Generally, when you're looking at most indexes, you want either full replication or sampling. That brings us down to just 17, and there's one final one which we can reduce this a little bit further, and that's the currency hedge. Now you'll see here, most of them are unhedged, but there are two options here, GBP hedged and Euro hedged. Now, because we're investing into global ETFs, of course, you're investing all over the world in many different currencies, and your money that you invest has to be converted. And of course, FX rates and exchange rates are always going to be changing. And the idea with a hedge fund is it tries to negate some of those changes. But for me, because you're investing in the global market, we're doing that because we want the most hands-off approach. I just want to capture the global economy. And what you'll find with a currency hedge fund is that it might work well in one direction, but it won't work so well in the other direction. And by going unhedged, in the long run, these things tend to even out. That now brings us down to 15, which is a good amount to work with. And if you wanted to, you could sort by fund size, TER, which is the total expense ratio, or ongoing charge, essentially the annual cost of the fund. You could sort by the performance or the number of holdings if you wanted to. But there's actually a unique thing with global indexes where we can filter this down even further, and it's to do with the index provider MSCI. You'll see with MSCI, they have a all-world fund and just a world fund. Now, the world fund is just investing into developed markets, where the all-world fund is more encompassing and it includes both developed markets and emerging markets. And in my opinion, if you're investing into a global ETF, it's because you want exposure to the whole world. We're doing global rather than picking S&P 500 or Europe or FTSE 100 because we don't want to pick a specific region. We want exposure to the whole world. And while developed markets have beaten emerging markets in recent years, of course, that's not guaranteed to continue. And that's potentially why people are attracted to these world funds who just invest in developed markets, because you'll look at the performance, especially over the last 10 years, and you'll see that it's outperformed the more encompassing all world funds. So to filter this down, what we can do is essentially I'm going to select all and then I'm going to deselect the ones that we don't want. So anytime it says world instead of all world, we're just going to deselect it. So for example, here, we're going to keep this one FTSE all world. MSCI ACWI, the ACWI is all country world index. So we can keep that one. This one is just world. This one's world as well. Deselect all country world. So that's fine. We're going to keep that. This is developed world, so we can untick that. This one excludes the USA. So again, it's been more active in picking a region, so we can untick that. This one is the all country world investable market. We're going to keep that one for now. This is actually an even more encompassing fund. We'll come on to that a little bit later. This one is just world fund. This one's all world, so we're going to keep that. This one's world. And these two both exclude the USA. So again, more of an active approach. And that leaves us with 5, which is a really nice number to compare. And we're going to do a side by side. To do that, you're going to come down here where it says compare selection, click the drop down and then click compare selection in detail. Now these 5 that we've selected are going to be very similar and there's not too much to choose between them. But depending on how you've done your filters and depending on what your goals are, you could have some very different results here, and that's when you can look at the pros and cons. The first thing you'll see is a comparison of performance. Now, like I said, these funds are very similar, and I wouldn't advise picking them based on performance. There's slight nuances between them, but performance is not one that we're going to use as a deciding factor. If we scroll down a little bit further, all of this I would ignore. The price doesn't really make too much difference. Fund size. Now, this is important because what you'll see here is the Vanguard FTSE All World Fund and the iShares MSCI All Country World Index are the 2 largest funds here at 16 and 15 billion respectively, and this is just the accumulation share class. Now, the reason fund size is important, and we slightly touched on this earlier, is that the smaller the fund, if it's too small, then you can run into liquidity issues. Now, none of these funds are too small. They're all huge funds. But when you look at the fund size and then also look at the total expense ratio, so the cost of the fund, what this doesn't take into account is an indicative spread. So that's the difference between the buy and the sell price. Generally, in a larger fund, that spread is going to be slightly less than in a smaller size fund. In the really big funds like the Vanguard and the iShares funds, it's going to be very efficient because there's so much liquidity there. There's lots of people buying and selling. So when you come to buy and sell, the market maker has so much more options to fill your order. The spread will change throughout the day depending on supply and demand and general market conditions. But generally, with the slightly smaller funds, in this case the Invesco fund and the SPDR funds, which is State Street, there will be a slightly higher spread than the larger funds like iShares and Vanguard. So when we look at the total expense ratio, that's the ongoing charge for the funds. You'll see those 2 larger funds in Vanguard and iShares also have the highest ongoing charge. So it's just something else to take into account. If you look at the other 3 and think, oh, well, these are cheaper and they're fairly similar, so I'm just going to invest into the cheaper ones. It could be cheaper in the long run, but just take into account there is also a spread involved. Another reason those 2 funds could be more expensive is simply just down to reputation and their name. You've got Vanguard, which is one of the most popular ETF providers, and iShares, which is BlackRock, which is the largest asset manager in the world. So what you could see as the Invesco funds and the State Street funds start to grow in size, those ongoing charges could also change as well. Everyone's going to have their personal preference with these global ETFs, and mainly it's just about choosing the right one for you. There isn't really a wrong answer here. For me personally, I generally choose between the Invesco FTSE All World Fund and the Vanguard FTSE All World Fund, but that's just my personal preference. Let me know if you've got a preferred one or if there's any others that I've missed. Remember, you can use this for any scenario that you have. It doesn't necessarily need to be global. It could be you want an S&P 500 fund. It could be you want a FTSE 100 fund and you just want to filter a few results. You can use it exactly how you want. So let me know how you get on with the platform. I hope you found that useful. Drop it a like if you enjoyed it, subscribe if you're new, and I'll catch you in the next one.